Hi folks, welcome back to the second part of our video where we're going to prepare a statement of comprehensive income for Blake for both years 5 and 6, and I've given you some selected data from their statement of comprehensive income. We're also going to calculate the ending balance in the investment in Sturgis account that would go in the balance sheet. Remember, we did say that's an important disclosure, so we need to make sure that that's included there. And we'll have to get that at the end of years 5 and 6. And then we're going to assume that Blake is private, and because under ASPE they do have a choice of whether they use the cost or equity method, we're going to assume they use the cost method. And we're going to do the journal entries in the statement of income for Blake for years 5 and 6. And then in part C, if Blake wanted to show the lowest debt to equity ratio at the end of year 6, would it prefer to use the cost or equity method to report its investment in Sturgis? And we want you to explain why. So let's begin our study again. So if you go to the solution, we're doing the income statement again, or as I say, statement of comprehensive income. It is for Blake, right? And it's for the 1 year ended year 5. So I took the sales revenue that we were given. Don't forget, I gave you some selected information, right? I'm taking that sales revenue. I'm going to use those operating expenses and income tax amounts in the solution. But don't forget, now that I've got my revenue, I also have to add in my equity method income. You'll recall from the earlier part of the problem, that's the profit before the discontinued operation. That is Blake's share of that. That's 25% of $51,800. So if you go back to the original question, you'll see that 51.8, that's 25% of it. That was the $12,950. So we're showing that just underneath the revenue because that's operating revenue or operating income, right? So we're going to get a total here of our total revenue of $1,012,950. From that operating amount, we will deduct, or from continuing operations amounts, we will deduct our operating expenses to calculate income before tax. We'll deduct our tax expense from that's tax expense on your continuing operations in order to get income before discontinued operations is $672,950. Now, we'll also, and after that, do exactly what we used to do in one of our previous courses, and after we calculate our income before the discontinued operation, the discontinued operation after tax amount will go in. You'll recall that was $2,400. You'll recall that from the question. It was $2,400, but we took our 25% share, and that gave us $600, right? So that's where your $600 comes from. And now we've got net income of $675,350, but we also have to add in the OCI, or our share of the OCI that Sturgis booked. Well, our share of the OCI was $2,850. Again, you'll remember in the question that was the OCI. So 1/4 or 25% of that is $2,850. So again, we're taking our share of that onto our income statement to show comprehensive income for Blake of $678,200. So if you look at this format, you should see that this is very similar to the format we used in previous courses. We get our income before discontinued operations, we add in our discontinued operation after tax, and we add in our OCI to get comprehensive income. We're going to use a similar format here. The only difference is our sales revenue now is $1.3 million, and we're going to look at our equity method income from our profit before discontinued operations, which was our share of the amount of $148,000. Again, you remember that amount from here. Profit before discontinued operations, $148. Well, 1/4 of that is $37,000, right? So that's going to give us income from our operating revenue from our continuing business of $1,337,000. We're going to deduct Blake's operating expenses, and again, they were given to you in the question as well, right? Right here, we gave you the operating expenses of $400,000. So we're going to deduct those, and we're going to get income before tax of $937,000. Now remember, I didn't or first of all, let me just finish this off. Now we've got our income tax expense. our income tax expense was again given to you here, 180 in the question, right? So all we're going to do here is deduct the 180 to get our net income. Notice I didn't say income before discontinued operation because you remember in year 6 we didn't have a discontinued operation. So to this net income amount, we're just going to add in our share of our associate Sturgis's OCI, which is $7,400. That's our share. You'll remember that any OCI booked this year by Sturgis in year 6 was $29,600. Well, a quarter of that, or 25% of that, is our share, which is $7,400. So we're going to get $764,400 as Blake's comprehensive income. All right, again, notice in the question, Blake itself did not have a DO, it did not have any OCI, but because its affiliated company did, or associated company did, we in year 5 took our share of the associate's DO, right? We also took our share of the associate's OCI, and we took in year 6 our share of the associate's OCI, but we did not take any DO because there was none. Okay, so now that we've calculated comprehensive income, let's move on to calculate the value in the investment in Sturgis account at the end of year 5 that would show up on Blake's balance sheet. So in this case, you'll remember in the question, I just set up as a T account here. You can do it however you want. You can just add and deduct with your calculator. I like to use the T account because it reminds you of where you started from. You remember if we go back to the beginning of this document, you'll see here right at the beginning of year 5, we recorded the investment at $1.85 million. That represented what we paid for our 25% ownership share. So what happened after that? Well, again, in year 5, we increased it by $12,950 when we took our 25% share of Sturgis's income before the deal. We increased it when we picked up the OCI gain, right, which was $2,850, our pro rata share, and we increased it when we booked our share of the discontinued operations gain, okay, that Sturgis had. So we increased the investment account 3 times, subsequent to this $1,850,000. Don't forget, we also had to reduce it by $18,500 when we got paid our dividend from Sturgis. So all I really did was take those little guys and put them in the T account. There's your $12,950, which is your, meaning Blake's share, or pro rata share, of the income before the discontinued operation, Blake's share of the OCI, and Blake's share of the DO. And that represents Blake's share of the dividend that they received, and that means the investment in Sturgis is decreased. So at the end of year 5, you would have a balance of $1,847,900 in the investment in Sturgis account, and that would appear as a long-term liability or long-term asset on the balance sheet. All right. Now, what about at the end of year 6? Well, again, if I started right from the beginning, I don't have to, but I put all the numbers in again. So you can see I'm here where I ended off at the end of year 5 because that begins year 6. What happened that year? Well, 3 things happened. Again, I took my pro rata share of Sturgis's year 6 income before the discontinued operation, which was my share of the $148,000. You'll remember that here. My share of that $148,000, 25% of it was $37,000, right? There it is right there. And I also had to take in my pro rata share of the OCI. Again, you'll remember that during the year, Sturgis had OCI of $29,600. Well, a quarter of that represents our share, right? And that is $7,400. So now, and don't forget, we also have to reduce the investment in Sturgis by the amount of the dividend. So if you go back to your December 31st, year 6 entries, you'll see that we made an entry at the end of the year to record our share of the dividend that we got from Sturgis, the cash dividend. And remember, that increased our cash because we got paid the dividend, and it decreased the investment in Sturgis account because, again, under the equity method, we see these dividends paid by the associated company as a return of our investment, so it reduces the investment in Sturgis account. So that will leave us with an ending balance at the end of the year of $1,873,800 in the investment in Sturgis account, and again it shows up as a non-current or long-term asset on Blake's balance sheet. Now, what happens in Part B? This is a little bit shorter, because if Blake decided to use the cost method because it's private, which it could do because it follows ASPE, note that no entries are made for OCI because the company follows the cost method, and under the cost method the investment stays at cost, right? So the only entries that we would make in years 5 and 6, first of all in year 5, would be to record the investment, which is still the same as it was under the equity method, because that's what we would have paid regardless of what method we used to record the investment when we bought our 25% ownership share. And that 25% cost us $1.85 million. Notice we don't take in our pro rata share of the DO or any OCI, because that's under the cost method. We don't do that. Right? It's not done that way. The investment stays at cost. But notice, with the dividend, we record it the way you would have seen it in previous courses. A debit to cash and a credit to dividend income. Again, we can't affect the investment in Sturgis account because the investment in Sturgis account stays at cost. So, we're going to credit dividend income. And again, how did we get it? We just add that. And there, we took 25% of Sturgis's year 5 dividend, and that was $74,000. That's our share, so it's $18,500. Oops, sorry. That should have been just 1 star, I think, because I think it's showing you that calculation. All right, so we're good. So now, in year 6, what do we do? Well, again, we're not going to record any pro rata share of OCI. We're only going to record any dividend income from our $74,000 that was declared and paid in dividends. Our share of that was $18,500. So at the end of year 5, we're going to have the investment in Sturgis at $1.85 million, as well as at the end of year 6, it would be the same balance. Now, if we had to do the income statement, okay, for years 5 and 6, again, it's quite simple actually, because now, because we don't show any comprehensive income, or OCI in this case, I'm just calling it a statement of income. So we've got our sales revenue, but notice now we've got dividend income here that we're going to put in here because we're using the cost method. Remember, we didn't record any dividend income when we used the equity method because it debited cash and it credited the investment in Sturgis, both of which are balance sheet accounts. But in this case, under the cost method, remember, any dividend that we receive from an associated company credits dividend income. And we've got that at $18,500. So now we've got our total revenues at $1,018,500. We're going to deduct our operating expenses for year 5, which Blake has as $300,000, and we're going to deduct the income tax expense. So we're going to get net income of $578,500. Similarly, in year 6, we also record dividend income. The only difference here is that, don't forget, our sales revenue changed. It wasn't $1 million as it was in year 5. It was $1.3 million in year 6. We had $400,000 in operating expenses. We deduct our tax expense, which is $180,000, and that's going to leave us with net income now at $738,500. Now, Part C of the question said, if Blake wanted to show the lowest debt-to-equity ratio at the end of year 6, would it prefer to use the cost or the equity method to report its investment in Sturgis? Briefly explain. So let's go back to our solution here. Certainly they'd prefer to use the equity method. Why? Because there's more equity method income recorded over years 4 and 5 for both of those 2 years combined than they would have recorded dividend income under the cost basis. Don't forget, under the cost basis, all we did was take into dividend income $18,500 a year. For 2 years, that's going to give us $37,000. Well, if you go back and look at all the equity income that you took in year 5 And in year 6, when you debited the investment and credit equity method income, if you do a total of that, that's $60,800. How do we know? Well, sometimes, if you go back to those little purple entries, that might help you. You remember back here, right? We had equity in the associate here that we took in, right? If you did these two entries together, that would be $44,400 right here, right? And then we also took in $16,400, right? So $44,400 plus your $16,400, which affected the investment account, because these guys here in year 5 and these guys here in year 6 all had a home in the statement of comprehensive income. So they increased your income. So the idea is here, under the equity method, your income got increased by $44,400 in year 6 and by $16,400 in year 5. So together, that's $60,800. And you can even see it, if you didn't want to go back that far, you can even see it in here. All these little yellow guys, these 5 guys, and these 2 guys here. If you added them all up, that's increasing the balance sheet account. But when you increase the balance sheet account, you're also increasing the statement of comprehensive income amounts by recording equity method income, right? So these little guys here and here, they're all going to add up to $60,800, which is certainly more than $37,000, right? So because your comprehensive income would be higher, it would be $60,800. Well, your comprehensive income would be higher under the equity method, right? So in turn, when your comprehensive income is higher, right, under the equity method, then don't forget, comprehensive income goes where? It goes to your AOCI, right? AOCI is on the balance sheet in the equity section, right? So you got to remember what we talked about in your both of your earlier accounting courses, well, at least 2 of them, right? Any OCI you had goes into AOCI, right? Any other income that you had there from discontinued operations or your pro rata share of any income before a discontinued operation, that's going to find its way through retained earnings, right? So retained earnings would have increased as well as your AOCI would have increased. Why? Because income increased and OCI increased. So those 2 guys together would increase your shareholders' equity, right? Total debt, whether you use the cost or the equity method, that wouldn't matter. It's not changing your debt. So under both scenarios, your debt would remain constant. But because your shareholders' equity would be higher under the equity method, what does that mean? It means that your debt to equity ratio would be lower under the equity method. So hopefully this makes sense. And I hope you found the video helpful.